Welcome to another episode of Monday Markets, brought to you by the FTX app. As always, before we start, please help support the channel by liking the video and subscribing to the channel. Also, leave a comment with your feedback. It's been very helpful, and we do love to hear from you. So, quick format breakdown is we'll do BTC USD, not a ton has gone on, and then do some educational stuff, which I think is relevant to coin price action at the moment. So, as for BTC USD, no wonder Don is still on holiday. Not a lot to write home about. The market continues to struggle with this market structure level and previous support turn resistance at 43, 44k or thereabouts. Now, if you want to make a bullish case, it has to be some version of the dumps from this level and the moves lower are getting weaker. So you've got this low, retest, higher low, retest, maybe a higher low again. And so the most optimistic iteration of this would essentially be, I know this pattern doesn't necessarily look bullish, but essentially that resistance reactions are becoming weaker, the market grinds, and then you get your expansion up. That's probably a bit high, but realistically, that will be the bullish case as long as the market is below resistance, which I know sounds like a contradiction in terms, but I think the only reasonable way you can carve that out is if resistance continues to get tested, the market continues to grind and creep up by making higher lows, and then you eventually get the level breaking, which is normally a very volatile event. Otherwise, in terms of where the market is right now, it seems stuck and magnetized, if you will, at or to this 38, 40k level. There seems to be a bit of a crypto native bid thereabouts, as we discussed, but really this, the weekly candles around this structure haven't been instructive in the very least, and we're still essentially dealing with two key structures. The first is, again, this is all higher time frame stuff, which can always be refined on a lower time frame. But in terms of Bitcoin's range low, you've got this 32 to 38k area, the bottom of which hasn't necessarily been tested yet, right? And I know a lot of market participants are eyeing up these lows, but maybe we go one level at a time. In any case, this structure in terms of support, 32 to 38k, the bottom of the previous, the range that was formed with the previous bottom, and just an overall area of, significance, if you will. And then on the top side, you essentially have the range midpoint comprised of this market structure level of 43 to 47k or thereabouts, and that's been capping the market as resistance. The downside targets, if this should break, are fairly self-evident. First of all, the lows, and then maybe as low as 20k, 14k, whatever, it starts to get into some real disaster territory. And that may sound intimidating, but it would make sense because for that range low to break, the bigger picture of the economy and risk assets in general would have to be pretty dire to get a kind of 30k is the new 6k breakdown. So that's on the one hand. In terms of bullish continuation targets, should resistance be broken, as we discussed, there's a lot going on at this 43, 47 level. Above it, a lot of medium and higher time frame trend metrics get flipped upwards. It would also take the market above the macro range midpoint, which all generally signals a move towards the range high. And so to me, my eye test at least is that the next trade would be towards 60k if this mid to high 40 area breaks. But for the time being, no such breaks to write about. The market is still stuck. Resistance is resisting, and support thus far has been supporting. Nothing really baiting me in to trade this at the moment. So as for the title, let's address some of those points. As always, we've got the good old copy paste ready. So if you want to just read that and go away, that makes sense. But please, like the video, subscribe before doing so. If you want to hear my rambling commentary, this is the place for it. Let me just quickly nuke the top part because it's not relevant. Goodbye. Okay, there we go. So now, first thing to note is that this list isn't exhaustive. So it's not the only buy setups that exist. And the second thing to note is it's by no means mutually exclusive. You can't have, it's not just one and you can't have any others. Oftentimes you'll see they complement each other or will be acting at the same time in the market. So what are these buy setups that it's worth being aware of as we're dealing with chop, uncertainty, and kind of meh conditions overall? Now let's go from the top. The first is just like your classic kind of blow off top, just the inverse, I guess a blow off bottom or capitulation bottom is usually referred to. And this is in essence a high volatility capitulation move and or usually accompanied by a liquidation cascade. And the basic premise is there that all the forced sellers are now, have sold. You have basically a climax in the selling, and there's only kind of one road for the market from there, which is up, albeit sometimes with a lot of sideways churn, etc. But usually on a number of time frames, forced sellers mark the bottom and forced buyers mark the top, or at the very least, the extreme of those liquidations is generally mean reverting, and therefore, when you get that on a higher time frame, that tends to be used as a top and bottom indicator or signal. And we're dealing with some really big moves here contextually. Now, what are the downsides or further considerations when you're dealing with when you're trying to identify a high volatility capitulation? The first thing is it could be leading, which isn't good. The classic example being the Bitcoin 6K break. The market was completely dried up of any volatility in 2018. Then 6K broke, and the worst trade to make at that point was trying to catch that knife too early, because that volatility picking up didn't mark the bottom, but actually marked the beginning of the dump. So that's always something to be aware of. And also, in general, and contrary to intuition perhaps, as we've discussed several times on this channel, when you get those types of liquidation cascades in an uptrend, it's actually not bullish, and that setup suffers in the context of an uptrend in general. Because what you tend to see is you have all this open interest built up, all this leverage built up, and everyone's saying, oh, just wipe it and just get it over with, pull off the band-aid, then we can go up. But what history shows us, just by even just looking at a daily chart of Bitcoin price against open interest, when those massive OI wipes take place and you get that liquidation cascade, very rarely in the context of an uptrend is at the bottom, but if anything, you just get more chop, more down, and more sideways, as we discussed at length. So some considerations there for high volatility capitulation or the whole liquidation cascade thing. In general, I'd say if you're really looking for the bottom or the top, we usually, bottom more helpful in this context. We're looking for these capitulations and cascades on much higher time frames. Dailies, weeklies, really candles that stand out, and even in terms of notional liquidations, really, really outsized moves. It's not worth picking at anything in the middle unless you're trading, shorter term, whatever it may be. The second should be quite familiar to the audience of this channel, which is the kind of a technical analysis oriented setups, or TA reclaim of key levels and or trend metrics. So that whether that's a support that has broken and turned to resistance and reclaiming that would mean something, whether it's some confluence of moving averages like the 21 weekly, 50 weekly, 200 daily, whatever your preferred trend, it could be ribbon, whatever it is, whatever your trend following metrics are, the market flipping above those or trading through those or being accepted above those on a higher time frame could also be a good setup to get back into the market. Yes, it's not the bottom setup, and there's obviously a lag between when the market bottoms and reclaiming those types of structures, but sometimes that premium or that quote-unquote confirmation is worth paying for because you get a clearer setup. Now, again, a couple of considerations. The first is not always super clean, especially on the moving average front. They don't necessarily act very crisply as support and resistance. You might just get some tall wicks, some mini deviations within that, and some weird price action. And the second point is that a positive one, of course, is that at least if you wait and quote-unquote miss the bottom, but then trade the momentum continuation via those key reclaims, you have a clear invalidation for those setups. You have a line in the sand, let's say it's 47K. You know that above 47K, you're clear to do business, but you also know where you're wrong, which is acceptance or move back below 47K on a closing basis, just as an example, right? So that's a good thing. And in something that contrasts point 2 with point 1 is that you do have a very clear invalidation as well as a clear entry criterion in that case. The second point number 3, maybe I should have put it after point number 1, but whatever, is a low volatility capitulation, which is essentially the market after the volatility has peaked is just grinding, moving sideways, doing nothing, and volatility dries up, having hit an extreme. Now, this is very hard to identify in real time, because normally, as I mentioned, what you'll see is volatility really pick up and explode, and then it just disappears. And so the expectation by many market participants, especially those who got battered by the volatile move, their expectation is, well, this is just consolidation before more dumping, right? Or that maybe this is just a quiet period before expansion, but it's all going to be in the same direction. It's very hard to identify in real time. But just contextually, it often, but not always, follows a volatility peak. If you look at some of the bottoms, especially the big, like, the COVID wipeout or whatever it may be, after it happened, after you hit that apex and climax, whatever, peak volatility, the market just did nothing for months, and you had this really kind of disbelief type of grind, but it wasn't bullish enough to trigger any momentum setups. It was just very rough, especially in contrast to the price action that follows. That's always one thing to be aware of. The best entry isn't necessarily the lowest or cheapest entry, especially if you lose your mind holding it into no volatility whatsoever. The more on the future side for point 4 is derivatives positioning aggressively, I should say, into a sideways market, which is to say that funding becoming negative or pronouncedly negative and staying that way, while the market isn't dumping and is moving sideways or maybe even up if a divergence starts to form. Now, again, this is one of those that's hard to spot in real time because you essentially end up arguing the premise that the market is doing nothing from a price perspective, and that's bullish because derivatives are expecting it to do something. That may seem like quite rational when you say out loud, and it is, but in real time, again, very tricky to make that case when there's really nothing going on. It becomes clearer, and perhaps some of the trade entries derived from this idea also become clearer when the counter trend moves form and stick. And by that I mean when you get funding staying negative and the market ripping upwards in terms of price, that kind of divergence is a good kind of confirmation that setup is going to play out. And you can kind of just eyeball what that would look like, right? I've got Coinalyze open here, our good friends there. There are some examples. So for example, this agonizing 30k bottom, you see the derivatives stayed bearish for quite some time, probably, especially in terms of like recent price action. This is the most one-sided positioning we'd seen in some time, and the market just continued to grind, did absolutely nothing in this period, and then you get your pop-up, which was nice. You could make a similar analog to the March 2020 crash, but given how exceptional these circumstances were, probably not the best analogy in the world, but this does make a good case for the whole grindy post-volatility peak price action to be aware of as well. So in any case, if you're going to be eyeballing this to kind of see what it looks like, we've had commentary of, oh, look, derivatives are bearish, or, they're trading at a significant discount. Derivatives are bearish and funding is negative, etc. For very short periods during these tiny little windows, and it doesn't really compare to the type of price structure or price to funding structure that you want to see if you're going to be making that case. So ideally, well, perhaps not ideally, but in general, you'd want to see price moving sideways or whatever, and then a whole sea of red here, similar to what you had in earlier in the year, or last year now, I suppose. So, these 1 or 2 days, yes, you can get short-term reads and lower time frame trading, eat your heart out, but for the purposes of this specific setup, it needs to be something really prolonged that gets absorbed. And there is a mechanism behind that, right? If you're, for example, holding a short position and funding is very negative, right? That would mean that you're paying whatever you're paying funding on the notional position size of that position, right? So if the market continues to do nothing and funding remains negative and you're constantly paying to be short, that exerts pressure on you as your collateral base gets debased, I suppose is one way of putting it. Point number 5 is, I saw the cat talk about this when he was talking to Barry, is basically price trading at value or forming some sort of deviation of value. Now, the tricky part is, of course, identifying what value actually is. It could be just like TA based of what's the bottom of a high time frame range or a really key level, or maybe some sort of really high time frame trend following tool that has been useful in identifying market inflection points, whatever that may be. And then when it comes to deviations of value, it's just you can phrase it or display it in TA oriented terms. So let's say this is your value area, we're going to put it at V, right? And then the market pushes into it. Now that could be a buy in itself, you're buying at what you believe is value, but then let's say the market pierces through it and then does whatever, and then eventually trades back above the value area. Then from a trading point of view, you could start to make a case that this move below value was a discount. The market didn't accept those prices and it pushed back up. That ends up being your deviation, and therefore it gives you a very clear invalidation for your setup. So you've got value area, excess below it that isn't accepted, or excess above it that isn't accepted in a kind of bearish case, and the market trading back within value could then trigger a setup that, this is some sort of bottom, right? Now, again, this is affected by recency bias, which is quite tricky. So, when Bitcoin's at 60K, you might think that 50K is an amazing deal, or from 70K to 55K, whatever. But obviously down at 30, some of those views get challenged, even though from, a high enough time frame point of view, it probably won't make a massive difference. So that definitely plays a part. And as I mentioned, actually identifying how do you find value, what does that mean, etc. That's also tricky. For me, it's really kind of just high time frame levels more than anything, but there are many systems which will give you different outputs. And again, the positive is it prevents very clear invalidation, especially if the deviation is formed, because then you know that if the market trades back below the deviation, you're wrong. So it gives very clear parameters to your trade idea. The final point, less chart oriented, well, somewhat price oriented, I suppose, is that when you have negative catalysts in the market which are having reduced impact and or are even being absorbed. Now, in the current climate, that's going to be very difficult to time and identify, given we've got like a lot of stuff going on, which doesn't do the state of the world any justice, but let's roll with it for the time being. What I will say in general, if you're looking for signs that bad news is having less market impact, which is, you know, bullish, right? Or the stuff or headlines that used to dump the market are dumping it less, or maybe it's even pumping now, like those types of shifts in behavior. In general, what I would suggest is a pattern of behavior. So seeing that happen across several headlines, right? Or say you've got relative strength, like, oh, BTC is decoupling from S&P 500 and other risk assets. You want more evidence for that case. You know, maybe a week of trading, or even a few sessions of trading, several headlines instead of one headline. It's really tricky because, you know, these are essentially counter trend trades, so you need to build a bit more of a robust evidence base for that to be the case. But in general, these sorts of patterns of stuff that used to dump the market no longer dumping the market, at least as hard, is also something to be aware of. That's kind of all I've got. It's not, again, a conclusive list or an exhaustive list or a top 6 or whatever, just some food for thought as we chop around 30K. I hope this was helpful. If it was, let me know in the comments, even just a yes, and I'd love to hear from you. As always, get the FTX app, support them because they support us, like, subscribe, do all the YouTube algo stuff that's really helpful for the channel. We're almost at 40K. It'd be nice to get over that before Bitcoin does. That's all from me. Have an awesome week, and we'll see you later. Bye-bye.